Hello investors, this is Beast McFeast with another video in my Retire Early series, where we will be discussing tools and strategies to reach an early retirement, and hopefully a more comfortable one. I don't know if you're seeking to FIRE or have a longer time horizon, but I do know that the financial tools that we will discuss here can be useful for many investors. Today, we'll be looking at growth ETFs to reach retirement, and we can look at dividend ETFs at another time. We're going to look at what ETFs are, what are some popular choices in ETFs, what strategies people use for this type of investment, some useful tips for investors, and some other interesting ETF options, because they're not all equal. Before we get too far, I want to be clear. Investing has risks, and I'm not your financial advisor. Not all tools we mention will be appropriate for your portfolio. I do not endorse or recommend specific investments, strategies, or anything really. This is for educational purposes only. And finally, past performance does not guarantee future performance. Exchange traded funds. That's what ETFs are. They are professionally managed pools of investments traded under a single ticker. They can vary in the number of holdings they have, the types of holdings, what sector they're in, different themes, whether they're leveraged or not, how much dividends they pay out, and what their primary objectives are. They might be active or passive in nature, where actively managed funds change their holding more frequently, and passive ones, as you might imagine, don't. The average expense ratio, which is the cost to manage the funds, is about 0.44% per year, or $4.40 per $1,000 invested. And you're not going to get a bill for this, it'll just be taken out of the holding. So you won't really miss it, especially if your ETF is going up. There are some similar alternatives like mutual funds, exchange traded notes, and just having a very diversified portfolio that you manage yourself. And that's fine for some people, though it's hard to beat some of these ETFs. You can check the card at the top of the screen for my video on closed-ended funds and interesting alternatives to ETFs. The first ETF that we are going to look at is SPY, S-P-Y, or as no one calls it, the SPDR S&P 500 Trust ETF. Its expense ratio is very low at 0.09%, and it pays a dividend of about $1.50 range quarterly, which translates into a yield of 1.3%. So this is not going to be like a high dividend ETF. You're looking for growth out of this. People don't typically buy SPY for the dividend. They want growth and security. This is a highly diversified and is often used as a reference for overall market health. Now what it does is it tries to track the top 500 stocks in the S&P 500. And at any one time, this has something like 506, 507 holdings in it. It tracks them pretty well. And you can see sort of the breakdown at the top right for what sectors these are in. Next up, we have VOO, V-O-O, which does the same thing as SPY, but slightly better over the past 10 years. The expense ratio of VOO is even lower at 0.03%, and it has a dividend of about 1.34%. So notice it's a lower expense and a slightly higher dividend, but not enough that you're going to want to hold it as a dividend investment. Again, you're looking for growth out of this, and that's what we're doing today. Over long time periods, it just narrowly beats the SPY. And up next, we have the Qs, QQQ. This tracks the top 100 non-financial companies in the NASDAQ. And as you might expect, if you know anything about the NASDAQ, this is tech heavy. The top 5 holdings are Apple, Microsoft, Amazon, Facebook, and Tesla. And their expense ratio is 0.2%, the highest we've seen so far, but still below the industry standard. And their dividend yield is 0.49%. Very low dividend, slightly higher fee. This one is just built for growth. And the Qs has returned over 200% in the last 5 years, which pretty well doubles the previous two. Finally, we have XLF. This is a financial services ETF, which gives you broad exposure to the financial industry. This might be a good choice if you want protection from, interest rate hikes, which are coming up if you're watching this in the end of 2021. Its expense ratio is 0.12% with a 1.57 dividend yield. Notice it's pretty great on growth, and it's a good place to put your money if you anticipate a dividend yield increase, as that tends to lower the value of the other previously mentioned ETFs. Well, those are some of the popular ETFs, but how do you use them? There's various ways to go about it. One option would be lump sum investing. This is where you just drop, $10,000 in. If you got $10,000 you're sitting on, throw it into an ETF. The downside of this is if you throw it in and then it crashes the next day, you're going to be pretty sorry. The upside is if you throw it in after a crash, you're going to be thrilled 10 years from now. An issue with lump sum investing is a lot of people very rarely in their lives are sitting on large lump sums of money to throw into an ETF. The next option on our list is dollar cost averaging. This is a very popular method where you essentially put in the same amount every so often, like maybe, $100 a week, $1,000 a month, whatever schedule you want to do works pretty well with dollar cost averaging as long as it's fairly frequent and consistent. Dollar cost averaging, sometimes called DCA, allows you to capture the peaks and the valleys on the graphs you've previously seen. Now, obviously, it's not great to capture the peaks, but as long as you're riding a overall trend upward with dollar cost averaging, you'll be better off than when you put your money in. Another thing that people do with these ETFs, especially SPY and the Qs, is trading it. They rapidly move in and out of positions, hoping to capture gains at a faster rate than the market's regular moves. Some days you'll see SPY move up 2.5%. That's what it moved 2 days ago. Moved up 2.5%. So if you were to capture all of that 2.5% move, exit your position, and then after it drops, enter again, you gained a little edge on the market there, and good for you. The downside is it's very hard to do, and it takes a lot of time. And then we come to more advanced options strategies, which aren't as advanced. They're just sort of spooky for a lot of people. And I'll do videos on this shortly, where I go into what are covered calls, which is one of the strategies, or leaps, or the poor man's covered calls, which is a combination of leaps and covered calls. Then you have condors and butterflies and lizards and probably some other animals. And these are just different ways to extract value from these ETFs. For the average investor, time in the market beats timing the market. So dollar cost averaging is probably your way to go, especially if you're not going to watch things closely. Here are some tips to ensure success with ETFs, or at least greatly increase your chance of success. Nothing's really sure. Consistency is king. You need to consistently add to your position if you want to end up with a larger position at the end of whatever your time frame is. Those small dividends on growth ETFs can add up and can be used to increase your holdings. Most brokers I know of have a DRIP option. It's a dividend reinvestment program that just automatically puts the dividend you get from a holding back into itself. It's important to remember that market corrections hurt, and they hurt more when you sell at the bottom. So if you are confident in the overall direction of an ETF, don't let a bad day or a few bad days get you out of it, because it's very hard to recover from that. It might be better to lean into it on a bad day for these ETFs. You really want to diversify your sector exposure, so you probably don't want SPY and VOO in the same portfolio. They do the same thing. Look into getting some ETFs that are in different domains, and maybe some that work in different ways to try to capture gains in more market conditions. And finally, use tax-advantaged accounts when possible. There are several to choose from, the most popular being is a Roth IRA. Go ahead and use that if you can to not pay capital gains on these when you finally do sell them. Let's talk for a minute about some more interesting ETF choices. The first one we're going to look at are the ARK ETFs. We're not going to take a close look at them. Maybe just be aware that they exist. They are actively managed and seek out very high growth potential. They're looking for things that might disrupt whatever market they're in. And there are several to choose from. They are designated by the final letter of ARK. So you'll have, ARK K and ARC-Q, and various other ARCs, and you can look up the ARC ETF website on your own time. These have outpaced the growth of the market by a wide margin in the past 5 years. It's been kind of ridiculous, actually. I don't know if it's going to continue. I kind of doubt it's going to continue in such a ridiculous way. We're talking 3 and 4 times the growth of the overall market in these things. They are slightly higher risk ETFs, though. They're volatile. Another sort of safe haven ETF is XRLV. And this one strives to be resistant to rising Fed interest rates, which are likely to occur in the next year. So it might be good to be resistant to that. Another interesting choice would be some REIT ETFs. They're ETFs that hold REIT-heavy portfolios, which can translate into higher dividends or higher growth. Depends on which REIT ETF you get. Finally, there are themed ETFs. One of them I'm going to mention here is UFO. It's appropriately named because it strives to ride the growing space industry to the moon. Another one would be SLIM, SLIM. They are heavily invested in weight loss companies. So it's good to take a look around and sort of think about what ETF can help you accomplish what you're trying to accomplish or fits your philosophy for the market. Thank you for watching. Please leave any questions or ticker recommendations in the comments. Good luck. Get rich. Bye.